Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. My name is Pushpendra Mehta, and my guests for today are Jack Large, editor of CTMfile, and Craig Jeffery, managing partner at Strategic Treasurer. Welcome to the Open Treasury podcast, gentlemen. This week, we are covering 5 themes that address 8 stories. To keep us moving quickly, we'll combine some related topics, and it will be up to you two to help us meet the goal of brevity with depth. Our themes for this week are economies and energy crisis, bank acquisitions and disinvestments, bank and fintech activity, technology spending, and finally, reduced chip sales. You can read these articles and also research content more deeply by visiting ctmfile.com or by following the links in our show notes. Jack and Craig, let's begin our discussion with the first section that revolves around economies and energy crisis. Hong Kong's key borrowing rate has surged to its highest since the 2008 global financial crisis, tracking rising global rates amid expectations of aggressive rate hikes by major central banks. This is expected to add a further downdraft to the city's struggling economy. In Germany, Deutsche Bank has launched a new loan program termed as Energy Loan for small and medium-sized businesses to assist them cope with the sharp rise in energy costs. And spiraling European gas prices that have risen by up to 30% have stoked fears of a recession in Europe and pushed the euro to under 99 cents against the US dollar, its lowest mark for more than 20 years. When you hear of aggressive rate hikes, sharp rise in energy costs, and inflation slowing global growth, from a treasury perspective, what is your biggest concern? If I may start with you, Jack.
The similarity of these stories, they're just different versions of the same thing. The world is heading to recession. Like all good treasury people, they need to put together ways of managing this. They can't escape it, and it's a matter of what do you do first. With SMEs, yes, there are problems and banks are getting involved. We're getting record borrowing interest rates, not just in Hong Kong, but around the world. So we've got the ingredients of a recession. Whether it comes sooner or later, I don't think it's a matter of if. The only way you can compete with this is be conservative and take every safety option you can.
Based on historical situations where we find out later that, yes, we were in a recession in this region or globally, I think it's pretty clear we're in a recession in many, many parts of the world, and we'll find out in more detail later. And so I think the concerns are, how deep will the recession go? That seems to be probably the biggest question there, and this energy issue is feeding into that as well. So like Jack said, we're hearing a lot of the same iterations about rates rising quickly, concerns about, are we in a recession? Are we getting a recession? We're getting deeper. We're seeing that across the globe in economy after economy. The Hong Kong one is interesting just because of their particular situation. We see the gas price issues in Europe sucking up quite a bit of the funds to pay for that, pay for the energy that you have to use to cool and then to heat, to run your economy. And Treasury should look at these things as there is high volatility across a number of factors, not just one or two. Caution is warranted. The risk management behaviors of looking at everything from currency exchange rates to upward pressure on rates drives people to secure borrowing sooner, or should drive people to make sure they have diversified access to capital as they need it through the supply chain, through their banking relationships, and beyond. I mean, there's a lot of signals moving in the direction of move more cautious. Within whatever your envelope is that you operate in, you should be moving towards the more cautious and liquid side of that envelope based on your policies.
There's one other factor here, which is, and you mentioned it briefly, Craig, the recession or the impact of this recession is going to last a long time because the number of businesses will have to dramatically change to even survive. This is going to have an overall impact for many years, I'm afraid.
Both of you mentioned two important things. One about being cautious and the other impact that could last many years. I wonder what you would say about our next section, which is about bank acquisitions and divestments. British banking giant Barclays has pulled out of Africa 6 years after first announcing exit plans. It said it has sold its remaining 7.4% stake in South African lender Absa, signaling the end of its 97-year retail banking experience on the continent. In Singapore, the virtual banking sector has grown significantly in the past few years, and the launch of Trust Bank via a partnership between Standard Chartered and retailer FairPrice should give digital banking a boost. The Southeast Asian Challenger Bank platform provides the typical retail banking service along with a numberless credit card, which the firm claims is a market first for Singapore-based clients. Jack, what are your thoughts about these two contrasting stories, one of divestment in Africa and the other about an interesting acquisition in Singapore?
I think this is part of a bigger trend, which is that banks are having to become much more nimble to survive the different pressures around them. The Barclays finally getting rid of the rest of their stake in Absa has been happening for quite a while the Banco Santander using a third-party processor to increase their services is just a natural thing. And we're going to see more and more of this. The issue for corporate treasuries is going to be, how do you manage the balance as things change?
I'll jump in here too. I mean, Barclays and Standard Chartered, two major banks. Every significant bank has to make decisions about how they're going to treat their capital, what regions, what countries they're going to be in. They need to look at these over long term, and that's the example of Barclays pulling out of a continent. Everyone has limitations on how much they have and what they can do. So here's one, a long-term divestment to refocus in other places. And Standard Chartered looking at the digital bank and being able to, a fast-growing area like Singapore, a strong nation, and, an area of growth in the digital bank. So taking advantage of where is growth happening, support your core, grow, and invest in areas that are going to give you outsized returns. This seems to be very logical, and this is what we're seeing banks do across the board, moving into different regions, moving out of and into different regions, moving into different types of technology or service functions.
The other feature of the developments here is that banks are getting unlikely partners. Who would have thought of Standard Chartered basically getting together with a trade union to introduce a digital bank? Corporate treasurers just need to accept that this is going to happen more and more. The issue for them is, how do you take advantage of the new facilities that are available to you? It's going to add more opportunities, but also more problems.
More opportunities. And our next section is perhaps an extension of what we just discussed right now, which is about bank and fintech activity. Trovata, a US-based fintech company that automates cash workflows for treasury and corporate finance teams, by combining data for multiple bank APIs, has signed a global distribution deal with Santander, a commercial bank headquartered in Spain. Through this collaboration, Santander is set to promote and recommend Trovata's cash management platform to its corporate and investment banking clients in order to streamline treasury workflows using data-driven automation. Craig, if I may direct this question to you first, what do you think about the Trovata-Santander collaboration, and do you think it will help Trovata successfully expand beyond the US into major European and Latin American markets?
That's an easy yes. I mean, you have two types of core technology developing, the growth of APIs from various banks to provide access to data, information, and transactions. That's what's being leveraged here. You have Trovata, a visibility payment accounting tool. Some refer to it as a treasury management system, where they're leveraging big data systems, cloud native technology, where it's rapidly scalable. And so as soon as they establish connections to another partner bank, all of these functions and features are available. So Santander is a huge bank, and this continues the expansion of partnerships with Trovata to leverage API connectivity and big data processing capabilities. This is a significant ongoing trend. I mean, it's not, any individual story is not significant, but this is more and more super regional and global banks are being able to support this type of platform. So yeah, I'd say it's more of the same, a core direction made possible by several types of technology together.
Jack, I would love your opinion.
The one additional comment I'd have is that this area of cash flow forecasting and liquidity management and the associated technologies, the API technology in particular, is becoming a crowded space. For me, the issue for corporate treasurers is not that you do it. It's which one do you choose that's going to have longevity, because there's no doubt in my mind there will be mergers between the different players. Cashforce being taken over by TIS is a classic example of what's happening. You have to bet in your decisions not only on the functionality in the system, but where it's going as a provider.
The next story for today revolves around US companies anticipating an increase in their tech spending to boost productivity. According to the American Express Global Business Spend Indicator report, 2/3 of businesses in the US anticipate spending more to increase productivity and efficiency through digitization and technology. This is despite inflation rates that are near a record high. In the survey report, inflation was named as the main factor having the most detrimental effect on businesses by 61% of US companies. What is heartening to hear is that despite inflation, US businesses plan to spruce up tech spending to augment productivity. Do you echo the same sentiment? And what is your key takeaway from the American Express Global Business Spend Indicator report?
I was happy to read this data that tracks with the research that we've been doing. Anytime we head into recessions or there's high inflationary time periods, there is often a pullback on investments. A certain percentage of companies pull back, bring their blood to the core of their body, if you will, and don't spend it in these areas. That's not always the case, but that's not been happening here. The spending has been strong. We've seen it. There's been no let up, not even by sector. The fact that we're not in a deep recession probably bodes well. People are trying to strengthen their defenses, leverage tech, get more efficient, because there's permanent benefits to that helps you weather the storm. And this is just more data that says, your peers, for those that are listening, your peers are spending and strengthening what they're doing with tech. And so I was quite encouraged by that. While I'm a little more pessimistic on the overall economy and the recession, it's not so deep, and people are spending in these ways, in these areas that will help us move out of a recession, or companies to just perform better. That's positive news to me. Jack, what about you?
I was not surprised by this at all. In fact, I was surprised in a way that it's a headline. The inevitable consequence of a recession is trying to become more efficient and effective with less people, less resources. And this has always happened during recession, unless they're dramatically bad. The issue for me is, where is the technology taking them?
The eighth story that warrants discussion is about US limiting chip sales in China and Russia, causing stocks to decline, NVIDIA and other chip companies. NVIDIA disclosed that the US government has attempted to impose restrictions on its data center business in China. Subsequently, the company's share declined by 6.6% in after-hours trading, after falling 2.4% to close at US $150.94 this week. The news, according to analysts, could pose a structural risk to the entire industry. Nvidia is reported to be the business most impacted by the regulation, although shares of other US-based manufacturers of server chips also fell during after-hours trading. Craig, in the light of this story, do you think that the US has taken preventative measures to deter Russia and China's military from acquiring high-performance semiconductor technology?
No, I think this is more reaction to what has or hasn't occurred in the past. But I'm no expert on this by any stretch in terms of, Taiwan as a producer of chips and the big push in the U.S. to build out chip producing capabilities. This is an area that has been watched of late and will continue to be an area of focus. This drives so much of our tech. The tech drives so much of our economy. Economy, defenses, global trade, and ability to operate effectively. So this is a crucial area to watch. I don't know much beyond that, but it's much more reactive than long-term planning, a long-term planning focus.
The point I think that's important is that here, this is just an example of the stresses and strains in the global political arena. And treasurers have to understand more about the consequences of these so-called little happenings might actually end up with them not being able to do their technology the way they want. And so the strategic thinking within corporate treasury actually needs to expand to take into account these geopolitical forces.
Both of you made some interesting points. Finally, I would like to wrap up this conversation by seeking your opinion on your choice for the biggest or most important story of the past week and why. Jack, if I may start with you.
Okay, the most important story for me is across all of them, the corporate treasury becomes more and more strategic and needs to think out of the box in terms of how they do their operations, where they do it, and with which partners.
For this week, I picked the increasing tech spending to produce productivity, largely because usually we see a downturn when there's a certain level of recession, and I think this is a really positive sign for, there's a lot of negative things going on, but people are investing heavily. When we saw COVID take place, there was I would call it the lost quarter of technology spend. Many things were paused or put on hold. That occurred, at different times when there was tightening in the market, in the U.S. The Fed started their quantitative tightening and put stuff back in the market, slowed things down. Any type of activity like that created a pullback on the spend, but we don't see that right now. This is a real positive thing, given all those negative headwinds and cross currents that we see.
Absolutely. I couldn't agree with you more. Thank you so much, Jack and Craig, for your insightful commentary. And a big thank you to our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.